Shares are one of the most well-known and popular financial instruments around. When you buy a share, you're literally purchasing a small part of a particular company. It's a unit of ownership. The more of a company's share you buy, the more of it you own. Let's look at an example. ABC Limited is a privately owned company. It sells computers and is currently worth £10 million. The owners want to raise some money so they can expand into new territories. To do this, they decide to sell a portion of the business by issuing stock to the value of £2 per share. You believe that ABC, now ABC plc, has good products, a clever business strategy, and a bright future. So you decide to invest £10,000, enough to buy 5,000 shares. You now own 0.1% of the company. As the months pass by, your investment proves to be a shrewd one. Computers are flying off the shelves, and ABC's results show massive growth. Consequently, the share price has risen to £3. The value of your investment to £15,000. You can now choose to sell the shares and take your profit, or you can choose to hold on to them and hope that ABC will become the next Apple. But of course, share prices can go up or down, and it could have easily gone the other way. So, when trading shares, it's important to research both the company itself and the industry it's in. Finally, an added benefit of trading shares is the potential to receive dividends. These represent your share of the company's profits. Some companies, but not all, can pay out dividends monthly, quarterly, semi-annually, or annually. The amount you receive depends not only on the size of the company's profits, but also how much the management distributes to shareholders and how much it reinvests in growing the business.